Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger & Associates Financial Planning. I'm pleased to have as my guest again, Brad Sorensen, chartered financial analyst and CFA consultant to our firm from Cornerstone Portfolio Research. Brad, thanks again for joining us.
Great to be here. Thanks for having me.
So we left off on the last episode talking a little bit about where we were. Now let's talk about where we're going. The bunch of things that we can talk about. We left off the last episode talking about where the money is going, and it's showing that it's going towards momentum stocks, but that it's not going towards, or at least the factor is towards low volatility, which basically is the fear of missing out. People are looking at the Mag 7 and say, holy smokes, look at how great these are doing. I want to ride that train. I don't want these boring stocks that earn money every time, et cetera, et cetera. Now, what we're doing is we're walking into the beginning of earnings season, okay? So this is Q3 earnings, corporate earnings season that begins, and by the time this episode airs, it'll be right in the teeth of the beginning of the earnings season. And as we discussed and believe in, a stock's value is based upon its earnings, which is profits, its profit growth, its dividend, and its dividend growth. So all comes down to the profitability and earnings, which has been, everybody keeps an eye on. Thus far, year to date, it's been tricky. It's been tricky because of the fact that the tariffs that were announced in early April, 100%, and all these wacky, crazy numbers, all of a sudden caused a tremendous amount of fear to ripple through the system, where businesses were afraid. They don't know what's going on. Consumers are afraid. Is this going to have an impact on inflation? Is this going to have an impact on corporate earnings? It's just a whole litany of different things. And then all of a sudden, it kind of fizzled out where they backed off on the tariffs, and the impacts to the economy weren't as great as what they expected or what they feared. And that's probably the best word. And what's happening now is they're realizing, hey, it's not as much of an impact. We talked briefly about it in the first episode, and Brad pointed out that basically a lot of those tariffs are either being absorbed by the other country, the businesses, and by the time it makes it to the consumer, it's not increasing as much. However, the fact that it is impacting the consumer means it's going to create inflation. The fact that it's impacting that businesses eating some of it means it's going to have an impact on business profits. Those two things right there, to me, present a concern for earnings and the future. So share with the audience, please, your thoughts on both the inflation piece as well as the corporate earnings potentially coming down as a result of tariffs.
Yeah, and that's what, like the earnings season, as you mentioned, we're going to be in the heart of it. And what will investors be paying attention to? They care about the earnings releases, but they really want to hear the commentary. Are they seeing price increases? Are they having to raise prices? Are they eating some of that, which is cutting into margins? We've heard both of those things, and that's where investors are going to be concerned. Heading into the earnings season, we've seen positive momentum, especially among tech, where we've seen earnings estimates over the past quarter for third quarter. During third quarter, companies will adjust their estimates based on what they're seeing, and we've seen a record number of raises in the tech sector. So going into the third quarter earnings season, investors are pretty optimistic that we're going to continue these growth rates and the tariffs won't be that impactful. But that's where we want to see, because now we've seen several full months of these, and even though they varied a little bit and we've seen court decisions, that is going to be one of the main commentaries. Are companies becoming more comfortable with these tariffs? Have they settled at a rate where they can deal with them, which seems to be the case because the administration has adjusted some of those and made exceptions for others. So that has helped these companies. And then we're going to get an idea of consumer demand. I hate to bring it up, but we're at the start of holiday shopping season. And I know, it's already there. If you go into stores, you'll start to see Christmas stuff. But this holiday season is going to be very interesting, and investors will start to be listening to retailers very closely right now, because what happened was, as you mentioned, in the tariffs, a lot of companies loaded up on inventory before the tariff effect hit earlier in the year. So now they're going into this holiday season with a lot of inventory, somewhere between, depending on the company, 15 and 30% above their normal inventory levels heading into a holiday shopping season. So they need consumers to come through, or they're going to have to heavily discount. Now, this is getting a little wonky into the holiday season, but this feeds into the consumer confidence, the labor market, all those good things going to hold up. So these companies aren't stuck with inventory. That also matters to consumers at the base of all this. You know, people say, well, we have AI. Well, it's customers, it's consumers that are ultimately going to use these AI things. They're going to sign up for these services that are going to pay up for AI related items, AI enabled phones, AI, all of these things. And companies are going to be invested in AI based on their consumers buying their products. So the consumer is really at the heart of this. And that's where the earnings season, we're going to get a lot of commentary from the retailers, how well the consumer is holding up.
Well, so I'm a little confused on that, Brad, from two perspectives, and I'd like you to elaborate. First of all, what you said absolutely makes sense. However, we're not really going to see this until the fourth quarter. And if we're not going to see this until the fourth quarter, then any company who's reporting its earnings over the course of the next few weeks is only going to be reporting what they forecast for the fourth quarter. But we won't really know whether or not the consumer is spending until maybe a couple points during the fourth quarter. Like you get companies like Amazon Prime. How do they do on their Prime Day or whatever the heck it is? And then companies who have the Black Friday and then the Cyber Monday, that really isn't going to be until deep into the quarter. We won't know until this time in the first quarter of January of next year. Secondly, share that, and then I want to ask the second question.
Okay. Yeah. And Mike, you can pretend you don't know when Amazon Prime Day is, but I know you have it marked on your calendar so you can order up your holiday goodies. Um, it matters because these retailers, that is their job, that they can forecast the consumer with remarkable accuracy. So the third quarter, really, that's for those companies, and really for the AI companies, those earnings are important, but they're not going to matter a whole lot. The stock market is forward looking, 6 to 12 months. So they're going to be looking at what are the trends. And we can see, has the consumer early, because US consumers start shopping for Christmas in September. Are we seeing early trends that show that the consumer is waiting for deals? Are they really pounding things on sale? Are they not spending for full price things? Is traffic starting to pick up? And what are they seeing? We'll look at the financials. What's the consumer debt load going into the holiday shopping season? Will they be able to? What are the credit card delinquencies? Are they going to be able to spend the way they were? And it's really just at the margins. High income people can spend and they'll spend whatever. Very low income people will just get by. And it's really that middle, just a couple percentage points one way or the other. If a family decides to spend $800 instead of $1,200 on the Christmas holiday season, and a bunch of families start to do that, that starts to impact these retailers. And with that elevated inventory, that could cause some problems for margins. And then that starts to affect business confidence and consumer confidence. So there is some risk here. But like I said, going into the holiday season and this earnings season, the consumer's held up well. Unemployment remains very low. So people have jobs and inflation has come down, which makes people feel better, although it's still relatively elevated. So we're in a decent shape to start it, but that's what earnings season helps with is, are the Targets, the Walmarts, the Home Depots, Amazons, are they seeing that continue, or are they starting to get nervous about what the state of the consumer is?
So you referenced that companies bought a lot of inventory and in like March or April in advance of the earnings. I'm sorry, in advance of the tariffs. However, that suggests to me that their corporate earnings were low in Q1, Q2, because they were buying all this inventory, impacting their profits. But now that they have all this inventory, they're selling it without the cost, which should improve the profits in Q4. Am I missing something?
No, in theory, that's good. But a lot of times what they'll do is amortize those costs depending on where it was, or say these are costs that we're delaying until we won't report on these costs because these are fourth quarter costs that were pulled forward. So let's report part of them. There's a lot of kind of funny business they can do there. But what really matters is, yes, if they're able to sell those things at full price that they have, they'll come out very well and the profits will be very good. But if they have to discount those and sell them at cost or below cost, then they're going to have some problems and the earnings estimates are going to have to go down and the consumer's in trouble. And that's really the bigger thing. Like, it hurt the retailers somewhat, but what it'll really impact is the overall economy as the consumer pulls back. And that would be the concern. Not that that's what we expect, but that's the message it would be sending, that the consumer is tapped out. And that's definitely not the situation we want to be in.
So it sounds like Q4 is going to be an extraordinarily important quarter on the consumer. So you said something else a few moments ago, that the stock market is forward-looking, and it has always been a leading economic indicator, which we can talk about because that's like a thorn in my side. But if it's forward-looking and we had such a great Q3, is that suggesting that the U.S. economy is going to be looking good in Q4 and Q1 of 26? Because if that's truly the forward-looking, then that's what it's telling us.
I agree that the stock market's telling us, and a lot of the indicators are telling us that the economy should be, the economy surprised to the upside, to be honest, over the course of 2025 to this point. Second quarter was revised higher. Third quarter is expected to be in the mid to upper 3%. That's well above expectations beginning the quarter. And then going forward, the stock market does indicate that the economy will continue to do well. And you have support for that from major things, with the Fed being accommodative and the federal government, despite their problems, that with the big beautiful bill, which is what it's officially called. I don't love that name, but that also is going to inject some stimulus into the economy that helps the economic growth trend to the upside.
Well, this is a good breaking point. What we'll do is we'll pick up in the last segment. We're going to talk a little bit more about the future because we kind of left that off with the stock market predicting. So we'll talk about Q4. We'll talk about 26 because I was surprised to see some pretty favorable forecasts for earnings in 26. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're going to pick up on our final segment, kind of looking forward. Some of the looking forward is also looking back, and it's kind of where we left off on the prior episode, where we were talking about momentum seems to be the biggest key. And a couple comments with momentum. I think you were talking about also small caps have a little wind at their back. by the Fed. So we want to talk a little bit about the Fed because we didn't discuss that at all. The Fed cut interest rates a few weeks ago, and it's projected that they're going to cut it 4 or 5 more times over the course of between now and the end of 2026. That is just injecting money into the economy, so to speak, and it's providing support, but it always makes the concern, is this going to have an impact on inflation and things along that nature? So I guess the 4 topics we want to talk about is the momentum factor, the Fed, jobs, and 2026 earnings projections. Where do you want to start?
Sure. Yeah. With the momentum, the thing about momentum, and I want to point out, and we talked about this before, that some of the gains are momentum related, that people are fear of missing out, as you mentioned, that the stocks have gone higher, so they're just going to buy the ones that have gone higher. But there is also a fundamental basis because they are making money. These Big 10 stocks, these Mag 7 stocks, their cash flow and their earnings have been growing at a very rapid rate, and that helps to underscore their rise in the stock price. But there is a momentum component as well. And that's the component that is hard to predict. That's why investors get a little nervous that going forward, what shifts that momentum? Where does that momentum end? Is it an exogenous event? Is it a disappointing earnings report? Is it just a, miss on growth, and in Nvidia or Facebook or something like that they still grow a lot, but it's just not quite as high as, or is it even a comment that a CEO makes or a Fed member makes? Can that shift the momentum? So it's hard to know what might shift that. So that's why it's kind of dangerous, but we do have the underlying fundamentals that investors can focus on, and that's what we've seen still be good. And as you mentioned, going forward, we have a supportive Fed for the stock market because they are in an easing bias. If people are having trouble sleeping, they can read through the minutes of the meeting that were released recently, that from the meeting that the Fed cut rates, and the minutes are just basically a note taker in the back that notes what they're discussing about, and you start to, it's a PhD to parse the language, and some participants, that's where you have to go. But it appears that most participants are expecting cuts to continue, as you mentioned, at least 2 more this year. And then it gets a little more uncertain going forward, 3 to 5 next year. But the main point is that they're more concerned about the employment market than they are about the inflation scenario, because inflation remains above their 2% target that's stated. And employment hasn't really risen yet, but they're concerned that unemployment is going to start to rise due to business uncertainty, the tariff effect. So they want to get ahead of that because rate cuts have a lag. They don't really impact the economy for 12 to 18 months is what most economists figure. So they're trying to predict what will happen in the next half year to year and a half and react to that. So it's obviously not a exact science, but they try to get it right, and they want to err on the side of supporting the economy, supporting the employment market, keeping people employed. And that also helps the small caps and that's why a reason it helps employment, because small companies need that capital and they can borrow it at a lower rate. So that's why small caps, kind of wrapping it all together, that's why small caps tend to go up when the Fed starts to cut rates, because they get easier access to capital.
So you referenced inflation, and that some of these rate cuts and everything else are arguably inflationary. However, one of the things that I believe, and please clarify if I'm wrong, which is entirely possible, but a major component of the inflation is the cost of housing or housing equivalents. And that has finally become on the downslope. And if that's truly on the downslope and it represents a major component of inflation, then the Fed may see ahead of that. Do you think?
Yeah, that's certainly possible. And I think they are looking at that because that's one of and that's been mentioned by a lot of economists and even some Fed members, that the ability to, because real estate is a very local thing, so the ability to have a great national barometer of real estate can be difficult. So they use what's called owner rent equivalent, which has never been, it's usually lagged behind what actually is happening in the housing market, but that gets again wonky, so I won't go into that. But yeah, we started to see that come down, and I think the Fed is seeing that. But the risk, and I just want to point out the risks as well, that between the tariffs and the new money coming in from the big beautiful bill and the Fed cutting interest rates, if the consumer starts to really spend money, that will raise prices again at the consumer level. Like we'll see, gas prices start to go up. We'll see food prices start to go up. We'll see those kind of things. And that's really more important than the housing thing at that point. So the housing is coming down. And if we keep prices at the same level or even just gradually going higher, then we're in good shape. Inflation will come down. It's just the risk that they run, and they know this and they're willing to take it, is that they overstimulate and we see a resurgence in inflation, but they know how to stop that as well. So they're comfortable with erring on the side of a little bit too loose of a policy at the risk of inflation to enable to make sure the employment market doesn't fall apart.
Well, so interesting. It's a lot of good insight. The one thing that I used to love, and for those of you who read my Monday morning recap, which includes Brad's analysis from the prior week as well, I've always loved the leading economic indicators, which comes out every month, but I've become to unlove them because they've been predicting a recession for quite some time now. They're not predicting a recession. These are basically put out by the Conference Board, which is a governmental organization, which is talking about the different areas, the 10 different areas of the economy as leading economic indicators. And the one that just came out, which actually just came out, but it came out for August, showed that 6 of the 10, including the 4 largest, were negative. But they were negative in 23 and 24. In fact, they've been negative for over 3 years. And they've historically been a pretty good indicator that a recession's coming after it goes about 6 to 8 months negative. It's been negative for 3 years. So I'm a little frustrated by that. But that was even something that Matt Miskin from John Hancock even talked about. It's almost like throwing that to the wind because it doesn't seem to be working, so to speak. But you talked about leading indicators that you're watching. Please share.
Yeah, part of the problem that I think comes with that broad index of leading indicators is there are several, and we've talked about this before, there are several confidence readings in there, consumer confidence, there's a couple of business surveys in there, and those can be fickle. And people can, I used to lie before, but maybe not lie, but be confused about what they may not feel good, but their actions may be different. So that's where I like to look at what are they actually doing. So there are 2 indicators that really have been very reliable, and that's jobless claims, although we have hopefully we'll get this corrected by the time this airs, but we are not getting that number right now because the government was shut down. So that's what we need, but that's a leading indicator of the jobs market is these initial jobless claims. Are companies laying people off? Now, we can look at a lot of other things, but people, when they get laid off, the one thing that they will do is they will file for unemployment. And that's where this initial jobless claims come from. So you get the hard data. It's not a survey. It's not calling people and seeing if they have a job. It's actually people that are filing for unemployment. And then the other thing is a little bit inside information, but it's not that hard, is credit spreads. What are people having to pay above treasury rates to borrow money? Traditionally, when the economy is going well, when people are confident the economy is going to continue to do well, spreads are low because they don't think companies are going to default. They think they have enough money to pay their debts. And that spread narrows between treasuries and companies. And that's where we are right now. We're at historically low levels of credit spreads among high yield, which is the ones that are a little more risky, and investment grade, which are the safer ones. The spread between the treasuries and those is historically low. So I'm watching to see. That's been a very good indicator of if there starts to be economic concern, those spreads start to widen. They investors start to charge more money by higher interest rates for certain companies or all companies because they get worried about repayment, and that spread starts to widen. So those are the two things that I'm really looking at as indicators to see if we continue this bull market.
So on that note, you referenced one of them as being the weekly initial jobless claims. Well, we got a little bit of a problem here. Isn't that a governmental report that comes out every Thursday, but it didn't come out October 2nd, nor did it come out October 9th. And with hopes that if the government shutdown ends, then it'll come out next week. But what do you do in the absence of the initial jobless claims? Actually, they're going to follow up with another question that you can also answer. Is when the government shutdown is over, will they go back and provide the prior data, or are we going to have a skip of a couple weeks of data where there's like no data?
Well, it depends on what it is. Some will be backdated. Jobless claims probably won't be because the unemployment offices are closed for the most part. So there won't be claims to go back and look at. So they'll just start again. So there'll probably be some volatility when we start again as some of that backlog gets taken up. And so that's part of the problem. But there are alternative sources that people are going to start to look for, like ADP, one of the largest payroll providers, provides some good payroll data at the private level. And then that's where we're going to be listening to companies to see if they're laying off people as well. And hopefully by the time this airs, the government's back open again, so we'll start getting the reports again. But yeah, there will be a time where data has to be taken with a grain of salt because they'll be catching up, they'll be filling in some gaps, there'll be some lags, those kind of things that we have to not. And I always say this, don't pay any attention to any one report. It's the trends that matter. And that's going to be even more true as we get the government reopened again, which eventually we will.
Lastly, I want to talk about 2026 projections for earnings. I was actually shocked that they continue to look good as far as the economist projections for earnings, but you also have a little bit of tongue in cheek. You're not exactly excited about the validity of the data. Can you talk about that?
There's some bias there when people make these expectations for earnings, and I understand it. They want to be positive, and they think that history will continue in the future. They're not really great at predicting turning points. And as we've talked about and previously, that we're getting to the point where now people are starting to ask questions about these AI companies. Like, are they making money? How far can they go? What are the revenues going to be from AI? And there's going to be winners and losers. Just like this is where it is similar to the internet. We've talked about that before. It's very different from the internet bubble, but one thing that's similar is a lot of companies went up during the internet bubble, and there were only a few that continued on and did well. And there may be more with these AI companies, these AI related companies, but there's going to be winners and losers. And that's where we're starting to get to. Investors are starting to ask, boards are starting to ask, how are we going to make money off of this? We're spending a lot of money. We need to make money. So that, I think 26 is going to be a big year for that. So some of these earnings are probably a little overly optimistic in some areas.
Well, it's interesting you say the reference that I make is back in the early days of Facebook. And, not to talk about any particular company per se, other than just to use them as a reference, because this is certainly not a recommendation for or against. But companies have a way of figuring out how to make money. And back in the early stages of Facebook, I scratched my head and said, hey, this is a beautiful tool for people to keep in touch with each other, et cetera, et cetera. But how in the world does a company make money on that? And lo and behold, they figured it out. They do it through advertising. I'm like, never thought of that. So now with the AI companies, you're pointing out that investors are starting to get a little antsy that these AI companies are spending a boatload of money on producing and creating this AI, but where does it generate revenue? Well, I could see that instead of, I guess, Chat GBT that everybody uses for free, I could see a lot of these things having subscription costs, them selling the use of AI to pharma or biotech for their uses and selling the use of the AI to different companies. That's where I see it. But a lot of times stuff comes out of the woodwork that I would never considered.
Yeah, and that's what I think I want to point out is that, we know some obvious places where we could make revenues, but as you mentioned back, with the Facebooks, with Amazon, I think that's the example I always use that people thought, why is Amazon? You just sell books. How many books can they sell? I don't even know if people remember. Amazon was just a bookseller when it started, and that was revolutionizing booksellers. Well, very few people envisioned it would become the behemoth that it is now in the retail space. And that's where there will be some companies, and that's where I said there's going to be winners and losers. And there will be some companies that will come up with things that we're not even thinking of. And that's the exciting part is where will this lead? But it won't be every company. And there won't be the demand for all this AI because some of these companies will go away because they just won't be able to sustain themselves anymore. And that's where you start to, and that's capitalism at its best, that the companies that succeed and do well will be rewarded from that and will pare it down a little bit. And that's just the process that I think where AI enthusiasm has lifted a lot of boats over the past couple of years. Some of those boats will start to sink, and while others continue to rise, I think at 26 there'll be more of a differentiation, which will separate the winners from the losers.
Well, it sounds to me like the chip industry is starting to get a little crowded because, NVIDIA emerged in the last couple of years as the AI. And the next thing you got AMD, Advanced Micro Devices coming in, and then you got Broadcom, and then Qualcomm, and then now the government's throwing money at Intel and all kinds of stuff. It sounds like they're resurrecting a bunch, but now there's a whole bunch of companies in that space. And to your point, I expect some of them to succeed and some of them to not.
Yeah. And that's capitalism at its best. And we can talk about this. This would be like a 3-podcast episode, but a sign that we're getting kind of near an inflection point is what I'll call it, where we start to separate winners and losers, is we have a bit of a circle going on right now where OpenAI is investing in like AMD and they're helping them to develop chips. So then AI can buy, or AMD can buy OpenAI products and services. So it's kind of like paying AMD to pay them back. So, and NVIDIA's done some of that too. They've invested in Intel. There's a lot of reasons for that, probably getting good with the government, but also so Intel will use OpenAI or NVIDIA services. So that starts to be a circular pattern. So those things start to be a little, is money starting to run out? As growth rate going, and that's what we're going to see is the law of large numbers. Just the growth rate is not going to be able to continue at this rate forever. And we're starting to see that now where companies are starting to question that spending. So the growth rates are still going to be impressive, but they just aren't going to be able to continue to increase at the level that they have. That's just math.
Right. Well, so we're wrapping up here, Brad. Sounds like you're cautiously optimistic overall.
Well, I kind of hate that phrase because a lot of people say that, but yeah, you never want to bet against the United States, especially when the Fed is in easing mode and the U.S. stock market. I just want to caution investors that we don't expect 25% gains, and a year where we got 8 to 12% would actually be a normal year. So that's where I don't want expectations to get too excited. And that's where we could see, after really 3 really good years, 23, 24, and now 25, that we've seen good stock gains that are really quite above historical averages. We may see 26 be a year where we pause a little bit, take a breath, and have a little bit of a more normal year than we have in the past 3. That may be a little disappointing to investors, but it's probably good for the continuation of the bull market as we get those PE ratios back in line. But it's still, like I said, the economy's still growing. Earnings are still positive. The Fed is supportive. The federal government is supportive. There are problems, but for now, those are in the back burner. So for the foreseeable future, we think the bull market continues, just maybe at a less rapid rate than we've seen over the past few years.
Right. And I'll confirm that with the newspaper from 2027, and I'll let you know how 2026 did. So, Brad, thank you very much again. I really enjoy having you every quarter. For those of you who are viewing, I'd like to point out, if you're interested in getting our weekly market recap, we send it out every Monday morning, and it's basically a few paragraphs that talks about what happened in the economy last week, what happened to the markets last week, and we attach Brad's weekly commentary as well. So if you're interested in having that, then you can either go to our website, www.maaplanning.com, or you may give us a call at 610-422-3773, and we'd be delighted to put you on that list. And trust me when I tell you, you don't have to be worried about us sending you all kinds of junk and all kinds of stuff like that. We respect other people's inboxes, as I wish other people respected mine. So thank you very much for joining. Again, Brad, thank you for joining. I hope you have a great day and a terrific week. Thank you very much.